Hey, Assalamu alaikum, and a very good morning to all of you. Welcome again, and thank you for joining our webinar series. So today we have come up with another interesting topic, which is understanding IFRS 9 ECL requirements. So as you all know, IFRS 9 was implemented somewhere in 2018, January 2018, and since then there has been different challenges people are facing. So we have come up with different challenges on our clients' practical situations. We thought to share with you some insights on that, how we resolve them, how can we interpret the standard. Again, I have with me my team. So let's start by introducing ourselves. I'm Khushboo Mushtaq, the Director of Advisory at athGADLANG, and I'll be the moderator of the session. Along with me, I have Imad Uddin, my team member who has expertise in IFRS and he conducts various IFRS trainings. He has been implementing IFRS along with me on various clients of ours across the region of the GCC. And today we have a guest speaker, another panelist of ours. His name is Jacob. And Jacob is a mathematician, actually, he's a mathematical physicist. Wow. He specialized in statistical in, oh my God, it's a very long. Okay. Jacob, how do you do that? So Jacob is basically an expert on the qualitative analysis, and we have requested him to come with us and share some insights on how can he do the stress testing of the credit losses. And I've got to know that Jacob loves to build different kind of models that make visible no matter how the risk comes from the client. So I'm really interested to know how you can do that, Jacob, and how our audience that we have today, can be benefited out of.
I mean, what I hope we will try to show here during this hour is that IFRS 9 is so much more than just sort of regulatory compliance. It's really about understanding the core of your business.
Exactly. So every business is different, every challenge is different, every situation is different. So many different assumptions we do take since we encounter auditors as well. So we know how auditors are expecting us to resolve all those issues. And with our expertise, we are going to share with all of you how can you help out your clients maybe, or maybe within your organization, all these issues. Since I still understand the issues are still pending, because no matter it's been implemented from last 5 years, but we are encountering different issues from our clients, the practical challenges and all of that. So without further ado, let's start the session. The audience is here to hear about those challenges. Imad?
Sure. So let's start by specifying some of the key IFRS 9 requirements for impairment requirements under IFRS 9. So we start by the scope of IFRS 9 ECL requirements, what exactly need to be impaired under IFRS 9. And then we'll go through the approaches that we need to apply to each of the asset classes. And then we'll go to Jacob for practical approaches on implementation. So recognition of expected credit losses. What does IFRS 9 really say about to what assets do we need to apply ECL? Now, first of all, it talks about financial assets. So ECL shall be applied to financial assets, but not all financial assets. Only those recognized under para 4.1.2 and 4.1.2a. Now, that might be a little technical, but we'll go deep down into why we are specifying these para numbers. And then we have a lease receivable, which is, again, not a financial asset really under IFRS 9, it's covered under IFRS 16, but it is within the scope of impairment requirements of IFRS 9. Then we have contract assets. Contract assets are covered under IFRS 15, but the scope of IFRS 9 ECL requirements even comprise of that. And then a loan commitment and financially guaranteed contract to which impairment requirements apply. So basically, it's talking about certain financial assets under IFRS 9, for which we have specified the para numbers. And then we have other assets which are covered under other standards, which are also within the ambit of IFRS 9 ECL requirements. So understand that the scope of IFRS 9 ECL requirements is slightly broader than the scope of IFRS 9 itself, which means financial assets covered under IFRS 9. Specifically talking about lease receivables and contract assets under IFRS 16 and IFRS 15.
And Imad, maybe it's fair then to say here that, the idea that you have it rather is that if it's in substance is lending, like a lease contract, yeah, then it also goes here in. So that's a way to understand why we have more stuff than just sort of normal loans.
Yeah. Like basically, a financial asset is defined as a right to receive cash flow. So there are other assets which qualify for the definition, but they're only excluded because they are covered by other standards, right? So that's exactly what we're discussing here. What exactly is financial asset? So I have a simple question here. If participants can answer by commenting, do you think that cash at bank need to be impaired under IFRS 9? All right. Normally, cash at bank is seen as risk-free, asset. But there can be instances where there could be bank runs, because again, cash at bank is not in our own custody, and it's a right to receive cash from the bank. And if you specifically talk about a recent bank run we have seen at SVB, which was a large bank, and there was a bank run in March 23, and this resulted in a loss of all the deposit holders. So it's important to understand that even cash in bank is a right to receive cash, not cash itself. All right. Now, we talked about pair numbers. We talked about 4.1.2 or 4.1.2a. And if you talk about 4.1.2, it's basically all the financial assets classified as amortized cost. And 4.1.2a are assets classified as profit or loss through other comprehensive income.
Imad, sorry to interrupt. Can you please check if the chat is disabled? For attendees?
Yeah, I don't see an option to disable or enable chat. Let me just go into... Panelists can chat with host and panelists right now. I can do it on everyone. Attendees can chat with, okay, everyone. Now I believe it's enabled. Cool. So again, we need to have a clear idea of what financial asset we are talking about. So okay, we already have a lot of comments. Thank you, Abdul Jabbar. Thank you, Abdul Wahid. Thank you, Imran. All right, I have a simple question. Do equity instruments fall under the impairment requirements of IFRS 9? Because we do know that we have an option to designate equity instruments at fair value through OCI. So under that, in that context, can we impair equity instruments under IFRS 9? Any guesses here? No, fair value. Absolutely right. So that's what the deal is all about. Basically, we have to look at not just the classification, but also how these classification comes into being. And that's why we specify the pair numbers. When we talk about financial instrument or specifically financial asset, we can categorize it as SPPI and non-SPPI based on cash flow characteristic test. So a financial instrument that's solely payment of principal and interest is SPPI. Now, within that SPPI, we have to look at the business model test, whether that financial instrument or that portfolio is held to collect and sell, or held to sell. So if an SPPI financial asset is held to collect or held to collect and sell, only then it would have to be impaired. This is why we specified the paras 4.1.2 and 4.1.2a. These are specifically SPPI assets carried at amortized cost, or SPPI assets carried at fair value through OCI. These are the two kind of assets that would be impaired under IFRS 9. And any asset, any financial instrument that is non-SPPI cannot be impaired under IFRS 9. So even if it's an equity instrument, even if it's carried at fair value through OCI, it cannot be impaired under IFRS 9.
And Imad, if I can just make a very, very short add-on here. This is really something to think about already when you design a loan instrument. So this should not just be something that you care about in the accounting department. If you come up with a new product, make sure that it from the start satisfies the SPPI if you don't want the added complexity of fair value. So because it's very easy, the product department run out and they embed some weird derivatives in the thing, and then you sit on the accounting side and say, okay, now we have to do a ton of work that doesn't at all correspond to what the product is worth. So this is really something to care about in the whole company.
Yeah, true. So even when you're producing that product, you should be aware of the complexity that will be faced on the accounting side as well. Very true. All right, so scope of the impairment requirements. Again, this is just a list of all the items to which impairment requirements apply. So just as we first of all mentioned, investment in debt instruments measured at amortized cost. This is what's impaired in IFRS 9. Investment in debt instruments measured at fair value through OCI. Again, these are just 4.1.2 and 4.1.2a. And then lease receivables, as we just discussed, they are within the scope of IFRS 17. Credit receivables or contract assets within the scope of IFRS 15. And then additionally, we have all the loan commitments not measured at fair value through profit or loss. And financial guarantee contracts to which IFRS 9 is applied that are not accounted for at fair value through profit or loss. So these are the items to which we have to apply IFRS 9 impairment requirements. Okay, now what exactly is expected credit loss? Now, again, Jakob is from a very quantitative perspective, and obviously we'll be telling you in more detail about the modeling procedures, what exactly it is, and how old banking models apply IFRS 9 concept into Basel framework. But what at the core of it, what exactly is IFRS 9 trying to say? So basically, expected credit losses are the weighted average of credit losses with respective risks of default occurring as weights, which means IFRS 9 wants us to understand that to have a unbiased view of all the possible scenarios, all the most likely scenarios, and to weigh the losses in each of those scenarios and to have an unbiased view of what the expected losses are. So here's a simple example. Now imagine we expect the following scenarios to unfold in the future with regard to an exposure of $1 million. We have three scenarios, like the economists have told us three possible ways things could unfold. Now, this is just a 6 month loan, and you can simply assume that the interest rate is 0% or discount rate is 0%. So in scenario 1, we have a 2% probability that exposure would default. Scenario 2, there's a 3% probability, and scenario 3, there's a 5% probability. Scenarios 1, 2, and 3 have a 50%, 40%, and 10% probabilities of occurring, which means these are the weights of the scenarios. Now, there will be no subsequent recoveries, assuming interest rate at 0%. So what is the expected credit loss under this situation? So here's a simple workup. We have an exposure of $1 million. We have three scenarios, 1, 2, and 3. We can simply compute the loss of 2%, 3%, and 5%, assuming 100% LGD, 100% EAD. And so expected loss would be 20,000, 30,000, 50,000, respectively. When we multiply this by scenario weight, such that the total weight of all the scenarios is 100%, we come up with the weighted expected losses, and 27,000 is our expected credit losses under IFRS 9. Now, this was just to show a single point that we have to consider multiple scenarios, and we have to be unbiased about it. We have to weigh them in a way that's unbiased.
And maybe one thing to add here as well, because here you might say, okay, why do you not just have the average PD and call it a day? But the reason scenario really matter is that both the PD and the LGD tend to be scenario influenced. So typically the scenario where you have the worst PD, you also have the worst LGD. And there, this really interesting nonlinearity comes in. So this is why this scenario exercise is really crucial. And it's also a great sort of business exercise. Okay, your old businesses should always think about this sort of base case upturn, downturn. So make sure to get value out of this and not just do it as an accounting exercise.
Exactly. So when we look at and work out the scenarios, you not only look at what the accounting figures would be, we also look at all the other things that we should have noticed before, like looking at scenarios, pathways we have to go through. And for example, if there's a stress scenario, we might have some cash flow issues during that. So it will make you aware of all those things you should be aware of during that business. Okay, we have talked about what the expected means and what scenarios do in trying to expect the scenario, expected credit losses. But what exactly are credit losses? So IFRS 9 have a very specific definition for this. All contractual cash is basically a difference between two things. All the contractual cash flows that are due to an entity in accordance with the contract, and all the cash flows that the entity expects to receive, right? So the difference is basically the cash shortfall. But we have to discount it at an original effective interest rate. And so this is a very specific definition. Here is a simple snapshot of what it really is. Present value of contractual cash flows and the present value of expected cash flows. Any difference is expected credit loss. Now, this also gives us an idea that even if probably the same amount is being received, if it's not received at the same time as contractually agreed, there might still be expected losses. So have a look at this example. Let's say we have to receive 55,000 USD at the end of 12 months, at the end of 1 year. In reality, we expect to receive only USD 20,000 at the end of year 1 and 35,000 at the end of year 2. So basically, we are actually getting all 55,000, but we are not getting it all at once. All at the time contractually agreed, we are getting 20,000 earlier and 35,000 later. So what is the expected credit loss in this situation? So normally people have an understanding that if the counterparty defaults, only then we can have expected credit loss or credit loss. But even if the party doesn't default, it only makes a delayed payment, there might still be an expected credit loss. For example, if any penalty has been waived. So here is the situation. Contractual cash flows are 55,000, as we know. And so the present value of that discounted 5% would be 52,381. But expected cash flows are also 55,000, but their present value would be 50,794 because 35,000 discounted for 2 years. And so the expected credit losses in this case would be 1,587, despite the fact that contractual cash flows equal expected cash flows in nominal terms, but because of the discounting or because of the timing difference, there were still credit losses. Now, one might say that the counterparty has not defaulted, but because the definition of credit losses is that is a difference between present value of contractual cash flows and present value of expected cash flows. So it's really as simple as that.
Sorry, just a quick thing. I mean, if you think about this, if you let the other company sort of get away with basically not paying you the interest, I mean, you as a company have really taken a loss in that you have forsaken something that you really should have the right to. You let them pay later, and then reasonably they should have, if they kept the contractual term, they should have paid you more then, because this is to price for the risk. You take risk when you lend people, and you need to be paid for that. Otherwise, it's a credit loss.
Exactly. So let's say there was a concession, and let's say there was a restructuring where the counterpart did not have to pay any interest. In that case, even though the same amount has been received, it's still a credit loss. And that's exactly what this particular paragraph says here, IFRS 9, B5.5.28. So these are ECLs are probability weighted estimates of credit losses over the expected life of the financial instrument. And a cash shortfall is the difference between the cash flows that are due to an entity in accordance with the contract and the cash flows that the entity expects to receive. But because we also consider the timing of the payments, a credit loss arises even if the entity expects to be paid in full, but later than when contractually due. So that's the point we have recently demonstrated. Even if these same amounts have been paid, because they have been delayed and no further interest was charged, it would still be a credit loss.
And this can matter quite a lot when you deal with, for example, governments. Governments are often notoriously late, So if they come a year later with the payment, if you don't charge them for that, you have made a loss.
Indeed. Indeed. All right. Now let's talk about measurement approaches. Under IFRS 9, we now know to what financial assets or to which asset we have to apply the impairment requirements. We now know what exactly is expected credit losses. Now let's have a look at what are the two main approaches under IFRS 9. So IFRS 9 recommends two approaches: general approach and simplified approach. And the summary is that within general approach, you have to first compute 12-month expected credit losses unless there has been a significant increase in credit risk. But after there has been a significant increase in credit risk, you have to compute lifetime expected credit losses. Under the simplified approach, you have to compute lifetime expected credit losses from the start, which means you don't have to wait for any ECL to occur, any SICR to occur, any significant increase in credit risk to occur. You can simply start the lifetime ECL from the start. So we need to understand to what assets, to what classes of financial assets or financial instruments or other assets do we need to apply a general approach, and to what assets we need to apply a simplified approach. So let's talk about trade receivables. Any guesses? Do we apply a general or simplified approach to trade receivables? I need some answers here. Do we need to apply general approach or simplified approach? Noman said simplified, Abdul Hasib simplified, Sher Hazem simplified, Aileen general simplified. Okay, most of the people are saying simplified. Almost right. Simplified is the almost right answer, but have a look at this. Okay, when we talk about trade receivables, we have to look at whether they have significant financing component or no significant financing component. If the trade receivables have a significant financing component, the entities have a policy choice. They can either apply the simplified approach or they can apply the general approach. But if they want, they can apply simplified. They don't have a requirement. But if, for example, they want to, understate or not overstate their expected losses, they can opt for general approach because 12-month ECL would be still lower than lifetime ECL. And so there would be certain exposures to which 12-month ECL would be applicable. So if you have significant financing component in your trade receivables, you have a choice to apply general approach. But if you don't have a significant financing component, then you have no choice. You have to apply simplified approach. So generally, the answer simplified is right, but know that there is an option to apply general approach if there is a significant financing component.
And I mean, in general, you should say, I mean, if you have long contracts where you get money very late, I mean, you will typically charge money for that because it means expose you to credit risk. And then you already directly start to get into this of having a significant financing component. So, I mean, one should more see it as, yeah, if you have very short things, this is just to not bog you down. But if you start to have very long contracts anyway, start thinking about already when you structure the deal, shouldn't you really be structuring it with a financing component?
Yeah, exactly. And the trade receivables that have a significant financing that do not have a significant financing component would normally be expected to be received in a few months' time or a few weeks' time. And so there would not be any significant difference between the 12-month ECL and lifetime ECL, because there would not be anything more than any default might not be expected after 12 months because all the receivables are due within 30 days or maybe 90 days. And so
it just becomes a disclosure matter what column you put it in the disclosures, but it doesn't affect neither your balance sheet nor your income statement.
Exactly. All right. Do we apply simplified approach to lease receivables or general approach? Any suggestions here? Any guesses on lease receivables? Should we apply simplified? General, simplified, both IFRS 16. All right, we have already mentioned that although the scope of IFRS 9 does not include leases, but lease receivables are specifically included within the scope of IFRS 9 for the purpose of ECL requirements. And so the people who said both are kind of right, because for lease receivables, an entity has an accounting policy choice. Either it can apply the simplified approach or it can apply the general model. So you have a choice. Now the question is, for example, if I opt for something, can I choose to apply a general approach for trade receivables without significant financing component and simplified approach for lease receivables, or do I need to be concerned? Any answers here? Can I choose general approach for the trade receivables without significant financing component and simplified approach for lease receivables, or do I need to be concerned? No, yes. Okay. Here's the answer. First of all, I cannot choose to apply a general approach to trade receivables without significant financing component, because there is no option in that. If there are trade receivables without significant financing component, you have to apply a simplified approach. You cannot apply a general approach. So that was a trick question. Here's the real question. Can I choose simplified approach for trade receivables without significant financing component and general approach for lease receivables, or do I need to be concerned? So there are trade receivables without significant financing component. I want to apply a simplified approach to that. And there are lease receivables. I want to apply general approach to that. Can I do that, or do I need to apply simplified to both or general to both? That's right. We don't need to be consistent. The policy choice should be consistently applied within each class. So for trade receivables, I have to apply simplified on all. For lease receivables, I have to apply general on all. But I can have simplified approach for trade receivables without significant financing component and general approach for lease receivables. Okay.
And this, we should say, is a sort of general pattern in all of IFRS 9, that the whole goal is that, the matter is you look at sort of each sort of asset type or each sort of thing sort of very individually, and you make sure that you have a good way to satisfy that for each of them.
Right. So now we have discussed what IFRS 9 ECL requirements are, to what asset do we need to apply it, to which asset we need to apply a general approach, and to which asset we need to apply the simplified approach. But now let's look a little deeper into what the general approach really is. So under the general approach, we have to recognize losses, especially lifetime expected credit losses, if there has been a significant increase in credit risk since initial recognition. Now we will dive deeper into what is SICR, when do we determine that the risk has increased significantly, and why do we need to compare it with initial recognition? And the second, if the risk has not been increased significantly, we have to only compute 12-month expected credit losses. So that's the whole central idea of general approach. So what we need to further understand is what is SICR and how should we compare it? And imagine if, for example, if I have determined that a risk has increased significantly, can that determination be reversed? If, for example, I think that the risk has been reduced, can I go back to doing 12-month ECL? The answer is yes. So if an entity has measured the loss allowance for the financial instrument at an amount equal to lifetime ECL, but at the reporting date, there is no significant increase in credit risk compared to initial recognition, the entity shall measure the loss allowance at an amount equal to 12-month ECL at the current reporting period. So yes, you can shift from lifetime back to 12-month if there has been a reversal in credit risk.
But maybe one just important thing to mention there is that, let's say that you had a contract or like a loan, it's in time, you use 12 months, Now it becomes very delinquent. You move it to stage 2. It came without any expectations before. And now they managed to, just scrounge up enough money to be back on time with their payments. You know now that the risk is higher than you thought before, because before you thought, oh, this is the safest customer. Now you know that they could, this stress could happen again. So yeah, sure, you should, if you really think the risk have permanently moved down, you should move them back. But this episode of them being late should really be informed in your model, and might actually mean that they could permanently, you view them at a higher risk level. So it's a very important distinction between these two.
So what you're saying is that basically it's easier to increase the risk and it's harder to reduce your assessed risk because of what happened in the past. Because we are in a way we are viewing risk from the past instances, right?
Yes, and past delinquency information is one of the most important things that tell you about customer. A customer that from time to time tend to pay some mispayments or be late or something, that is a real indication that, right now they're not late, for example, but there is a real underlying risk. And this is something, if you didn't price that in when you started, you started them at a very low PD, you probably will place them in stage 2 because they show a different behavior than you thought.
Yeah. Let's say that a client, he has a good reputation in the market, he is a big company, and let's say the SICR happened just because of some bad transaction or some bad reputation, and let's say that thing went away. Now maybe you can revert the SICR because that was one-off event and was not representative of what we expect the company to, or how we expect the company to behave in the future, and that way we might come back to 12-month ECL again. So. And to cover those scenarios, IFRS 9 has kept the door open. So it's not a permanent designation to lifetime ECL. If, for example, for some reasons you can really reassess the SICR to not be there anymore, which means you can say that the risk has not increased since initial recognition significantly, then you can bring it back to 12-month ECL. Okay, how do we assess? How do we tell that there has been a significant increase in credit risk? Now, this is my question to all the participants. Let's say the expected credit loss on initial recognition was $500,000. However, at the reporting date, the ECL increased to $750,000. Now, should we recognize a lifetime ECL for this exposure? Do you think that there has been a significant increase in credit risk? Yes, no, could depend. All right, so we have really mixed answers here. Yeah, so the right answer is basically we don't have enough information to tell whether there has been a significant increase in credit risk. All we are saying is that expected losses increased from 500,000 to 750,000. Now, these expected losses may have increased because of increase in exposure. So let's say the total loan was $1 million. Now the total loan has increased to $2 million. Or let's say it was $10 million. Now it has increased to $20 million. Now the total exposure has increased, which has increased the ECL. So maybe the PD has come down. So understand that just because ECL has increased does not mean that there would be a significant increase in credit risk. And if that's the case,
this is very, very non-trivial because, LGD really matters in a credit assessment. So if your LGD suddenly goes up massively, you might say, oh, now there is much more losses on this. Yeah, but you only move it to stage 2 based on the PD. This is quite non-trivial, but the standard has decided that it's only the PD the assessment should be based on.
Exactly. So yeah, so just as Jakob said, when we assess the significant increase in credit risk, we have to look at the PD or the risk of default occurring over the expected life of the financial instrument. So we are not looking at the change in the amount of expected losses. We are looking at the risk of default. And risk of default has to be compared on 2 particular dates. Risk of default on the reporting date compared with the risk of default on initial recognition. So remember, we are not comparing this with previous year's risk of default. So there might be slight increase in risk, such that you might not notice a SICR over the years, but that's not how it works. You have to compare risk of default at the reporting date with the risk of default on initial recognition. So even if there are small changes to risk of default, total cumulative change would be assessed for determining whether there has been a significant increase in credit risk.
So if you take a really, really extreme example, actually, imagine you lend to a customer where you have ironclad collateral. You know that they have some property, you will always get the full loan back. But depending on how the actual risks are, you might have to move this asset to stage 1 or stage 2, and this is something you have to show in your disclosure. So even though the ECL might be close to zero, very small, it still really matters where the risks are. And I think this is great in that it enforces you as a lender that you should always be thinking about what is the risk of the customer, not just the final ECL on the balance sheet.
True. So here's just the summary of what we just discussed. Significant increase in credit risk is comparison of two things: the risk of default occurring on the financial instrument as at the reporting date, and the risk of default occurring on the financial instrument as at the initial recognition. Now, here's a practical expedient provided by IFRS 9. So if, for example, a financial instrument is determined to have low credit risk at the reporting date, we can say that the risk or the credit risk has not increased significantly. So if you have determined the credit risk to be low, you do not need to always compare the two PDs or two probability defaults, the PDs on the reporting date and the PD of the initial recognition. You can simply, if you know that the risk is low credit risk, you can say that the risk has not increased significantly. Now, IFRS 9 also provides a rebuttable presumption. IFRS 9 wants you to presume that any exposure that is more than 30 days past due has increased significantly in credit risk. And if you think otherwise, if you believe that SICR has not happened even after more than 30 days past due have passed, then you need to have demonstrated. If the entity has a reasonable and supportable information that demonstrates that the credit risk has not increased significantly since initial recognition, even though there might be delay in contractual payments, then the entity can rebut this presumption. Otherwise, any exposure more than 30 days past due should be considered as ICR. But remember, we do not have to rely on this 30 days past due information. Ideally, companies should be more proactive in their assessment of risk or identification of risk. So if they have information about an event that could have caused a significant increase in credit risk to the exposure, the entity should assess it and take it into consideration. 30 days is probably the limit over which you need to rebut the presumption.
And this is something, for example, auditors quite often look. I mean, how much of your SICR was triggered by the 30 DPD and how much were you able to sort of trigger before? I mean, it is a definite weakness of your indicators if sort of you solely rely on this 30 DPD.
Yeah, exactly. Especially if you're a financial institution, if you're a bank, you should have systems in place to track or proactively assess the risk beforehand. But if you're a manufacturing company, I don't blame you. Your main focus might be something else, trading, business development. And so you might be relying on 30 days past due information, which is very common. All right, now we talked about assessing significant increase in credit risk. And we have said that this is basically the comparison of the risk of default. But we haven't defined default yet. What is default, right? And the reality is that even IFRS 9 has not defined default. And it shall apply a default definition that is consistent with the definition used for internal credit risk management purposes. Now it's very interesting. So let's say an entity defines default as 90 days. Another entity defines it at 180 days. What effect would it have on its ECL? Now, on the first impression, it should not have a very large effect. Why? Because let's say the company that has defined its default at 90 days would have higher subsequent recovery and lower loss given default. And if a company has defined its default as 180 days, it would have a lower subsequent recoveries and higher loss given default. Right? That's what we see on the face of it. At the end of the day, all we will see is the comparison of the expected cash flows with the contractual cash flows. Right? In both the cases, irrespective of where you define the default. So the cash flows after the default threshold would not be disregarded. But the catch here is that the way you define default would have an effect on your SICR determination. If a company defines default as 90 days past due, might have different determination of SICR and a company that has 180 days past due default might have a different determination of SICR. And so the company with 90 days past due default would have more exposures for which the lifetime ECL would be computed, and the 180 days default threshold company would have less number of exposures for which would be computing lifetime ECL. So that's something that we can say on a slightly deeper analysis of why definition of default is really important. Although it doesn't affect the overall cash flows expected, it affects whether we are computing lifetime ECL or 12-month ECL. Now,
I mean, if you are a bank, you know, you typically will be tied down by capital regulations that really strictly define the definition of default. And I mean, then don't make life hard on yourself. Tie these two guys together and have them together internally, because I mean, again, otherwise management are never going to be able to work it out if you say, okay, default means this today and default means this tomorrow.
No, my point was if I'm comparing two different companies, one has a default threshold of 90 days and the other has a default threshold of 180 days. And so these two different companies should ideally have the same ECL because they have, let's say, same expected losses. But what I'm saying is because the definition of default would be different, there would be a different determination of SICR based on that. So that could result in...
100% agree. I'm more saying from a sort of practical point of view, I mean, just sort of stick with the sort of standard capital one. But I fully agree. This is very underestimated that, you know, if everything was lifetime, where you put, as you exactly say, where you put the cut should not matter. And if you see it really mattering, that indicates that your models are actually not performing correctly. So that is actually a good, you can even use that as a little bit of a validation tool. So I think that's a very, very good point to bring up, Imad.
Thank you. And as you said, the IFRS 9 ties it down itself. So the IFRS says the definition for default should be consistent with the internal credit risk management purposes. So whatever the entity uses for its own credit risk management should be used for IFRS 9 as well. So IFRS 9 does not want you to have two different definitions and two different, you know, that would be very messy. But IFRS 9 provides a presumption, however, that any amount after any exposure more than 90 days past due is assumed to be defaulted unless you have a very strong supportable visible information to demonstrate that there has not been a default.
And I mean, that is common sense. You know, if someone is 90 days late, what's really going on here? I mean, if you come again, if you take a little bit of the audit perspective here, and someone comes and say, you know, no, like they aren't in default, they're 90 days late. I mean, I would be like, okay, have you called them? You know, have you been in contact? What's going on here?
Yeah, so there's some clients who say, okay, I have a client who pays very late, always pays late, but he makes the payment after, you know, after every 2 or 3 months or 4 months. Or there are clients who say that we have, you know, majority of our counterparties are government companies, the government institutions, and they always pay late. And so that this 90-day presumption do not apply to us. So it's kind of a gray area, and people still have a lot of arguments for this 90-day presumption, especially in the manufacturing sector, where they are dealing with large corporations which pay late. All right, this is probably the last significant part we have: purchased or originated credit-impaired financial assets. So we talked about the general approach for the normal assets which were normally issued or purchased. But let's say we purchased assets that were credit-impaired even on initial recognition. For those assets, we do not have to wait for any significant increase in credit risk. We have to compute lifetime ECL even from the start. Now, there are some points to consider for such assets or such exposures. SICR is not required since initial recognition as the asset was already high risk. So there was already high risk. So we have to apply lifetime ECL even from the start. The financial asset was recognized net of lifetime ECL. So we don't have to have it on a gross carrying amount. We have to have it on net carrying amount, even on the start. The entity shall recognize favorable changes in lifetime ECL as impairment gain. So the point here is that because we have recorded at a net carrying amount rather than gross carrying amount, we can have impairment gains as well. And it can even increase that asset's carrying value above its historical carrying amount on which it was initially recognized. So these are some peculiarities of purchased or originated credit-impaired financial assets. And finally, credit-adjusted discount rate is used because the contractual cash flows are higher and the actual net carrying amount is much lower. So the discount rate that discounts those cash flows to the net carrying amount would be higher. And so the credit-adjusted discount rate is used. And so that's all from my side. We talked about the approaches, we talked about the ECL, and we talked about the scope. Now I would just give the floor to Jakob for sharing with us the insights into practical applications and key challenges. Before that, if you have any specific questions, please let me know.
And I should maybe first also say as a very short sort of disclosure that, you know, when I talk here, I talk in a sort of the general capacity about sort of my sort of personal opinions and not sort of directly speak for sort of the Handelsbanken as a company. Very sort of just standard disclosure. And I mean, again, the point is sort of we're discussing how do you do this sort of systems in general. So I don't speak about how our specific accounting works. But with sort of that out of the way, I mean, the sort of I looked at now if I could share my screen, but it looks like it has been disabled for me. I don't think, on the other hand, that super much matter. We can sort of Imad and you and I, we can sort of talk through some of the questions we discussed. I mean, one of the big questions you can talk about here is when it comes to sort of IFRS 9 is sort of how do you really do it? And we have already talked about a little bit about this, that, you know, the really key is that you focus on these PD, EAD, LGD parameters. These are sort of your three most important things to care about. And one of the things that's really important when you do application is to really think about the PD is not only about estimating the PD for the whole period, but it's also about figuring out the term structure. So when will the default take place? So you not only need to predict will an account default, you need to also predict when it will default. And the reason this matters is because as long as the customers are paying you, they are reducing the exposure. So your EAD is often smaller than the current balance, because the whole logic is that, I mean, if you have something like a bullet loan, it will be the same, because, you know, you will only get paid at the very, very end. So no matter when they default, your EAD is the same. But if you have that they pay you down, you know, if you have a mortgage and they, you know, the customer default tomorrow, they default in 10 years, that's default in both cases, but how much you are exposed to is very different. So this is why it's quite important to also work out the term structure, because this can really matter a lot for your sort of practical calculations. And really, when you set up the PD model, I always advise to look at something like, for example, survival modeling and similar, because the big advantages there is that you get the PD and the term structure at the same time. It is quite common in the industry, because sort of historically, to do things like logistic regression for PD, but then you also need to build a separate term structure model. So really take a step back there and think, you know, okay, do I want to get both things at the same time? Then I need to go more down the survival rate approach. And the other thing also to think about, the key reason that why when you do also the EAD is that you need to think about that. Basically what you need to think about is, okay, what would happen if the customer defaulted in 1 month, in 2 months, in 3 months? You look at each of these sort of scenarios and you say, okay, if they default in, for example, 2 years from now, what is the exposure going to be? How much will they have paid down? In practice, it's quite common, for example, to say, you know, assume that they are paying you fully, they do everything they're supposed to do right up until excellent. If you move just ahead, I think 2 slides here, we should get into where we are. Exactly. If you have the EAD, you really need to, here we are. If you have the EAD, you really need to think about that. You look at a bunch of different scenarios. You look at, which of each month do they default in, and then that you group these scenarios together, discounted. So again, do the work on each of them individually, aggregate it together, and you get your EAD parameter. And then for the LGD, what you really should be thinking about is what's going to happen once the default. Here, I think is an excellent opportunity, go out in the business and really talk with your credit department. What do you do about defaulted customers? So first and foremost, one of the important things to talk about is, once a customer default, we want to be good lenders. We don't immediately want to go and confiscate collateral and so on. We typically often try to work it out with them. Then what you have is often you call a cure rate model. So you often build a model where you say, okay, what's the probability that they get back on payment or they lose it? And similar, if they did not cure, then we go more into this recovery phase. Then you have to work out, okay, what are you going to be able to get from the collateral? And that has to be discounted as well. And this matters quite a lot at least here in the Nordics where we operate. We have quite strong laws on if you can sort of take, for example, a house from someone. That means that you often can end up in a legal process where you can be in a quite prolonged sort of legal battle, and that could be, above a year in time. And that means that if you have a 5% mortgage, the collateral has now been reduced 5% in value because of the sort of waiting time. And finally, and this is a quite underestimated factor, but you also, even if the customer cure, they were really close, or they even defaulted on you, as we talked about before, the risk is probably larger now. So you actually need to have a term that also incorporates what is the risk that they will default again into the future. This only matters if you are in stage 2, but that is not fully material. That term can really matter. If we go to the next slide. So then you can also say sort of, then you can also say sort of, it's quite popular, and we will make sure, I guess, to get the slides here also distributed, because some of the text are a little bit small, but I've tried to sort of take out where you can really see this from the IFRS 9. It's quite popular to talk about this, okay, forward looking, and it's quite mystic and everything. I really think people need to take this back to sort of down to the basics and say, why are we doing the whole forward-looking thing? The whole point is that, let's say that you went through really good times in the past and you had very low default rate. And now, you put on the news, you hear that, okay, we're about to go into a recession. The business knows default rates are going to be higher. So for you to provision on just taking the historical average straight out, not doing anything with it, that's not going to reflect what's really happening going forward. And this is why we do forward-looking. So I sometimes think that people sort of make it very, very mystic. Think of it more like, are you expecting the sort of average, for example, are you expecting the sort of average default level to change? Okay, then you need to have some sort of correction for that, And don't think that it's going to capture sort of the micro level, the month to month, or that's really hard to do. Think of it more that, you want there to be a difference between the sort of peak of the economic cycle and the sort of trough, like the bottom of the economic cycle. That's really what the realistic target should be for your sort of macro modeling. And I would also really advise, make use of a lot of the sort of research that are out there. Look at, what is the literature saying, which variables do really matter, because it's quite easy to, you have your data science department or quant department and you let them loose and they have 20 different variables. It's going to be very hard often to data-driven find these things because you have very little data often in practice. So often it makes sense to, start from, if you give retail loans, what is it that really expose customer to risk? Often it's, for example, unemployment. Okay, unemployment is then a good starting point. If you have corporate loans, GDP and change in GDP is often a good starting point. But there are other variables, and it matters. I know there are some countries, for example, that are very oil-heavy economies, or you have certain portfolios that are oil-heavy. Oil price is then very interesting. Here in Sweden, for example, we have looked at the grain price for farmers as a very good macro indicator, because it really matters to them what the grain price are. So again, here is really, this is knowledge that often exists within your if you are a bank or you're a lending agency, you know what's sort of going to affect it, and make sure that that goes into the models. And we talked about this before, but really I want to stress this: macro variables should influence both the PD and LGD. And the reason this matters a lot is that when your PD is the highest, because you are in a bad economic cycle, typically also your LGD is the highest. If you have, for example, in the 90s in Sweden, we had this massive sort of rental or housing crisis, where suddenly sort of housing prices fell, people struggled paying their loans. So then at the same time, PD goes up and LGD goes up, because you now have an oversaturated market. If we could go to the next one slide as well.
Jacob, I have a question here. How do you define
yes.
how do you define scenarios? Like when you talk about macroeconomic scenarios?
That's a super good question. So formally, in the ISAB have this really great presentation on this that I really recommend to look into. If you search for sort of scenarios, IFRS 9, something on the IFRS Foundation's website, I really recommend to look into it. But they basically say, you can imagine sort of any kind of macroeconomic conditions, and you would have this large super ensemble of, millions of different scenarios, and you would take an average of them. That's sort of the very theoretical thing you could do. Very few institutions do that. That's very computer intensive. What you rather do is that you try to find, I think I have some slide later on it, but to explain it, what you try to find a few scenarios that are sort of representative of the sort of overall level. So, you will have a base case, you will have a sort of downturn case, you will have a sort of upturn case, and you try to find sort of reasonable representations of this. And here it really matters. I think I mentioned it a little later, but I really want to stress this here. Make sure that your scenarios, especially your downturn scenario, is severe enough. Because IFRS 9 has a special paragraph, I think it's 5.5.18, that do say you really need to have a scenario where there is a loss. So imagine you, for example, have a very highly collateralized portfolio. You're not going to get a loss with a mild, if housing prices go down 10%, but you only lent out 50%, you're not going to take a loss on that account. But the standard tells you need to have scenarios that are strong enough to get a loss. And this is why you need this very sort of, you need a quite severe scenario as the downturn. But then to get the unbiasedness correct, you also need a pretty good scenario on the upturn. So what some companies do is that they actually do 5 scenarios, because then you can do a base case, you can do sort of mild downturn, upturn, and you can do severe ones and give them pretty small weights. Then there will always be a credit loss, but you will not be too skewed by this very, very extreme ones. But it depends a lot. I mean, if you have more sort of unsecured lending, you often don't need these real extreme ones, because you see the losses already at the middle ones. So I think that sort of is one of the important things when we talk about scenario. We seem to have lost Imad for a while, but no matter. We should see if there is. I think we're a little bit out of time, but I think I should see if there is something else that is important to mention as well. I mean, I took some notes on also what is the sort of most sort of common pitfalls, and one of the things I really want to stress is the difference between IFRS 9 and your capital calculation. This is in my practice what I've seen often is a mistake on that. When we do capital, we are very common of thinking about this. As soon as we're uncertain about something, we just say, okay, we're going to be conservative, and we stack on a little bit extra. And that's fine for capital, because that determines basically your capital structure of the company. But it is a problem if you do that for IFRS 9, because it's going to build up a sort of hidden reserve. And that's not sort of what you're allowed to do. So you have to be super clear on that, you target this unbiasedness nature. And we also mentioned, maybe as we take this as the final question here, sort of on the segmentation and how that works. So one of the things I really want to stress here, and this comes back to the sort of red thread that I try to have when I always discuss these topics, really tie it together with how you operate in your organization. So, you have this principle of undue cost. It's telling you, okay, you don't need to go out and search the whole universe for information, but you do need to use what you actually have available on the inside. If your credit department say, okay, when we do, for example, auto lending, okay, we have these different segments of customers. Some of them are really risky. These are medium customers. These are really prime customers. Yeah, you probably should keep that segmentation when you go on to model, because if it mattered when you originated the credit, it will matter day one when it goes over to the IFRS 9 system. So really think about, talk with the people talk to the people that monitor credit. I mean, it's quite common that, you have things like watch lists. You have things like, for example, you get placed on, you see a customer having a high risk behavior. If you think that matters in your business, it should matter for IFRS 9 as well. So what I'm really trying to send there as the message is, don't view this as like a black box in a corner. View this as a way to try to summarize in a good way how you're operating with credit and how you credit manage within your organization. And this is also sort of the core. This is why we have been given this freedom from ISAB. We don't have a prescriptive standard that tells us, you do A, B, C, D. We have this very open standard because they want us to give the ability to really reflect what really do matter in the organization. So use that freedom in a responsible way, and also use it to give good insights from on the inside. Sort of how are we on I think we are a little bit about to draw over on time, right?
No, I think we do have a bit more time.
Okay, but then then no problem then. Then another thing I would want to mention also sort of is when it comes to data quality, because that's often when you do the modeling. Again, this comes a little bit back to this sort of forward-looking nature. You have to really think about, if you've had periods that are quite strange, you need to do something about it. I took the example of COVID, and I've had here, we saw this in the Nordics, but I took some example from US that also showed it, that the delinquency rates really went down during COVID. People couldn't spend, people stayed indoors, and that meant that you had much lower delinquency rate. Now, if I'm just out of COVID now, and I take that data and I just apply that default rate to my accounts, that's going to be misleading, because these COVID things are over now. You don't expect this is what's going to happen afterwards. So for example, what you can do is you can use, for example, a dummy variable where you say, okay, when we were doing COVID, this variable is 1. When we were not doing COVID, this variable is 0. And then you train the model with that variable in it, because it means that when you come out of COVID and when you predict now, you set it to 0, but that then adjusts it. So you don't, the advantage is that you don't need to take it out of your data set, but you at least adjust for the fact that it is a sort of special conditions. And I think we covered, so there, if you could move on to the next one. And if this one we covered, so if you move on to and just click through this one. And to mention a few things on the next slide about sort of the practical sort of challenges. So one of the things, I mean, what is it that, can easily go wrong when you do your ECL modeling? And I want to mention a few things. One of the things I really want to mention is it's quite easy that, you have had changing underwriting conditions over time. So for example, you might change, because it's quite common when you have underwriting that you have, you have some certain policies and so on. And if you change these, you're going to see quite different credit quality. And that means that you can see quite different default rates. So if you, for example, just plot your overall portfolio default rate and you say, okay, now I'm going to infer how we are sensitive to the macroeconomic conditions, that can be quite misleading if you change credit quality. In fact, it can even be the reverse. It's quite common that during good times, you relax your credit standards, or many banks do relax their credit standards. And then you actually increase your default rate during good times because you took in more customers. And then when bad times come, you shrink your standards back in, and now the default rate goes down. And this can mask the actual macroeconomic dependence. So therefore, it's good to try to, for example, adjust for this, that when you do the regression, you also have, for example, you look at the credit score or some type of internal rating and try to use that for an adjustment to avoid this problem. Similar, I also really want to emphasize the importance of using as much data as possible. There are some places where people say, oh, just this now, because we did a bunch of changes in the past, we're just going to use the last 6 months or last 12 months. That's too little to be able to understand the economic cycle. So this is why it's really important that you have a good way of correcting if you, for example, change the portfolio composition, because you cannot just throw away all the data and say, I take the last year, because that's not going to be sort of representative of a full economic cycle. So, I mean, when you do IRB sort of capital calculation, they tell you to take 7 years. I would advise that, you do something similar also here if you have the internal data, because you really need to see your portfolio in ups and downs to understand the macro sensitivity risk. And finally, I also want to say one of the things that can easily go wrong in this sort of age of sort of AI and data, it's quite common that people say, no, we don't need to do all this sort of thinking stuff. We just sort of throw everything into a model and run it. The key here is that since you have, if you do that, you can quite easily, I saw once an example, and these 3 pictures I show actually talking for a case study we did where they took 100 variables, they built a regression model with 3 variables where they sort of took all possible combination of these 100 ones, and they took the best model. And you can see that the dashed line here is the sort of in sample, and then you have the out of sample. And what you see is you can get models that look perfect in sample and they just break together out of sample. So I always say, don't just start with a pile of 100 variables. Go out to your credit department and really go out with them and discuss with them what is it that matters. And I see there was a question here on the minimum number of variables. If you have a relatively small data series, often one variable is good enough. You often can get away with that. And that often, if you have, as I say, a very, very sort of not have much data, that often serves the trick, because you have sort of the height of the economic cycle captured in this one variable. I much prefer that than you having 10 variables and it's a massive overfit and it doesn't really provide you anything but like P&L volatility. So if we go to the next slide, and there was also a question that that I often get asked is this sort of the regulatory sort of impact. First and foremost, I really want to advise everyone, make sure read the regulatory text. Everyone who works with the standard should have it basically on. I even took this, you should have this on your taskbar, basically just ready to pull out. And make sure to familiarize yourself with it. It's too common that you have companies where you have an accounting department and they know IFRS 9, but then they outsource the work to their credit department. And the credit department, great people, but they don't know the standard. And that means that they model the wrong thing. This happens way often than you would even dare to sort of be truthful about. So make sure that there's good communication, but also make sure that the people that sit and model really understand what are they supposed to model. Because you can make the best model in the world, but if you target the wrong Y variable, it's not going to help you. And the second thing I would really advise is read a lot of what the regulators actually write. Here in Europe, we are very fortunate to have very good regulators. Both EBA and ECB write really good reports. And if you're outside of EU, I still say read what they write. You don't need to follow it because they're your regulators, but they're going to give you a lot of advice. And EBA, for example, their monitoring report should be, I think, a mandatory read. It's great. It highlights the strengths and weaknesses of different methods and are very concrete. And similar, ESMA, our sort of market agency, they write what's called enforcement reports. So they basically go out in companies and say, you have done IFRS 9 in an incorrect way. They do this with all accounting standards, but in this case, the IFRS 9 ones are really good. There was the one screenshot I have here was from a recent ruling on a debt collection agency, where they really showed how you do the forward looking and explained their expectations on this. So again, this is great sources. And similar, I always say, focus on the internal value. Make sure that your internal models, the IFRS 9 models, are good enough for management to use them. Because if management can't use them, then they are just going to be this box that sits in the end, and you're not going to get resources to the department. And I would also give the advice to really be a member of the sort of general community. For example, there is a great website called IFRS Community, not only for IFRS 9, but anything IFRS. It's a great place where you can ask questions, people discuss with each other. So really sort of outreach and talk with each other. I saw that there was actually in the chat a question on intercompany receivable or intercompany loans. I just want to quickly actually mention something about this, because this is one of the, on this forum I just mentioned, this is one of the most common asked questions there. And what you really need to think about is that they follow full ECL requirements. What really matters for intercompany loans is that you need to properly document them to make sure you cannot just say, okay, I gave some money and there are some expectations. You really need to have proper loan documentations, and you also really need to understand, are you giving them, if for example it's your subsidiary or it's a subsidiary to the mother company, are you giving market interest rate? If not, you have to split it into one part that is with market interest rate and one which is actually a capital transfer. So, if market interest rate on a comparable loan would be 5% and you give them 0% or 1%, you have to then make this split. This is super important. And it matters. Some people say, okay, but it's not going to matter in the sort of consolidation. And that's true. You take it out. But it does really matter if, for example, you have investors in different parts of the companies. They then need this information. And someone wrote there, what if there is no interest? Well, then it's an interest-free loan. I mean, its interest is 0%. So you have to then go out and estimate, what would I lend to a comparable company if I were given market conditions, as I say, let's say 5%. And then what you really do is that you take the contractual cash flows with 0%, you discount them using the 5% rate, and you say, okay, this discounted value, that's my loan. The rest, the residual, that's a capital contribution. So this matters quite a lot that you have done this distinction correctly. If we move to the next slide. Yeah. We have talked about most of this actually, so we can, so we can actually move on, because with this one, from the one we talked about the scenario and sort of how to set the different scenarios. So if we move on to the next slide. Here I really want to stress, when you talk about, because these models require validation and they require upkeep and they require love to work in the proper way. And I really want, if I want to give one advice, it is make sure that you have good, sustainable processes for updating them. So it should not, I mean, when you build or when you commission or when you have a third party doing something, make sure that, there is a clear understanding that this should be a very frequent updating process. It should be able to read in sort of new data and understand that in a good way. Because if you have too infrequent calibrations, if there has been a lot of change in the data, you could get these big sort of changes in the model, and that then comes in your P&L. And then your CEO or your CFO comes to you and say, I can't take, 200 million change right now, that's not working. And you get in this weird position where you have to somehow try to smooth it out and so on. Much better to do that naturally with just calibrating the model over time. Also, the strong governance and model risk is really like a key thing here. And it really matters that you need to have a validation department that is organizationally separate from your sort of credit building department. I mean, if you're a very small organization, it might not be as, but if you're any sort of banking institutions, I always advise that validation need to report to a separate person than the people building the model or sort of the credit department, because it needs to be that at the top management level, there need to be one person who sort of advocates for the model and one person that's sort of a little bit of the devil advocate, for there to be a good discussion for rest of management. So make sure that they have really sort of distinct reporting lines, and because there is a lot of money here at stake. You know, if you give out fairly risky loans, any changes to these models are going to make huge P&L impact, and this can be quite contagious. And finally, if I want to mention something about the actual sort of validation, there are tons you can say about how you do good validation. But if I want to give one advice, one of the challenges is when it comes to the macro modeling, because you know, only one outcome is really going to happen. So we often advise use what's called perfect foresight. Basically, insert the actual macro variables that happened, and then say, if I had known that these were the true macro variables, how good would my model have performed? That is often a sort of adequate test, because otherwise, you know, if some very extreme scenario took place, you know, you only maybe gave that a 5% chance. So that it looks like your model is going to be off, even though it isn't. And if we go to the next slide. And I mean, yeah, I think staging is that's a whole talk on its own. We're not going to fully cover staging here. We talked a little about before. I really want to stress the same things as I said before. Make sure that you look at your credit management process. If loans are on watch list, if they are given forbearance, if you have things like delinquency, I mean, things that makes you trigger on the inside and said, oh no, this is a loan that might be going bad. You know, yeah, that is what stage 2 is. Stage 2 should indicate what loans have you originated that now shows a different risk level. We talked about that it's only on the PD, not on the LGD. And we also talked that one of the things to think about is that when you do different scenarios, you have to first use all the scenarios and compute a PD and then stage based on that. And then you need to do the full ECL calculation again. So you cannot, I mean, otherwise it's easy to think that, oh, I run everything separately. I have separate PDs in each scenario, so I have separate staging in each scenario. No, you have to do one staging, because you have to show in your disclosures, you know, where do you place the assets? And there can only be in one place. So you cannot have different stagings in different scenarios. There was someone that chose here in the chat, should it be on borrower or facility level? It should be at facility level. This is really important, because if let's say you gave out a loan to a prime customer, they're a great customer, you gave them almost no interest rate at all, you thought they're going to be great, and now 12 months in, they turn out they're terrible. But they are really important for your business. So, you know, this original loan, you know, it's gone up to stage 2, but you actually decide to give them an additional loan. Now, of course, you price yourself good interest here, but you decide to give them additional loan because they are an important customer, for example. When you price this new loan, you knew about the risk. So this has now, the new facility now has a different initial PD. Hence, it can be in stage 1, while the original loan, where you didn't know this, is in stage 2. This is very important, that, you know, you can have multiple loans to the same counterparty and they can be in different stages. Similar, if you purchase loans, then everything starts in stage 1, because you know everything when you purchase the loan. Even if you have something where you're the one you purchased the loan for, with the only exception if you purchase them defaulted. But as we said, that's a separate set of rules. But, you know, someone have a banking book, they move stuff to stage 2, they sell it to you, you have everything in stage 1. That's for the same principle. And if we move to the next slide, I think that is the final one. I mean, we also talked about a little bit, what can you do about sort of data limitations? I always say, you know, make sure that your internal documents, make sure your credit process works, make sure that you have good active monitoring, so that you actually determine defaults, not only rely on the 90 days passively, but it should be the absolute final point, and you should really have an ability to detect that before. Data quality is something you really, really should care about. And I would even go as far as I would say it's a culture question for the company. Make sure that there are good ways to report for employers if they find data that's wrong. We often say data is the new oil, so treat it as the company asset it is. I'm showing this of sort of, you know, an oil rig on fire. You know, it doesn't really help you with your data if you aren't using it properly. And also make sure that, you know, you have a good sort of tracking way of showing when you sort of improve upon the data. And similar sort of in the IFRS 9 models, You also want to be able to sort of incorporate it into other things, stress testing, budget forecasting, and so on. The more you use it, the more your sort of IFRS 9 department can get sort of financing from the group or from your company, and the better models and the more, and you can get in the cycle. But make sure that you get into this sort of cycle. There got this very, very interesting question on restructuring. So I also want to cover this because this is a great question. So this question: if a loan is restructured, then the loan will be in the same stage before the restructuring happened? Question mark. Or will the stage be assessed again? So if this is a really technical question, but let me just shortly say, if you have a criteria which is called significant or non-significant modification, that's not the same as significant for a sicker. If the value, present value, I mean, if you give some very, very different loan terms, it's treated as a different loan as well. But in particular, if the value changes with less than 10%, it's called a non-significant modification. And what you then do is that you look at the PD, and you basically assess that. Most often, if you give the customer a restructuring, they're gonna be keep in stage 2, because you didn't give them that because the risk were I mean, the only way they would have been in stage 1 now is if you had already expected them to restructure, and that's really weird for you to give out the loan in that sense. Now, if they are above 10% in the change in present value, then you need to recognize it as a new loan. But now you need to be really careful, because things that go in on your book needs to go in at fair value. And that means that you need to fair value estimate this loan. And you cannot just assume that it starts out with its balance, because obviously you now know that you were forced to restructure it. So you need to do, then this sort of is more in the scope of IFRS 13 treatment. But you need to do that if you have a loan that you severely restructured, the value loses more than 10%, you need to go back to IFRS 13 and say, what is the fair value? What is it, for example, I could sell this loan on the open market to? Again, that's a whole sort of presentation on its own. I think there is one more slide.
I want to add a point here, that when you're talking about restructured loans, basically you're comparing the probability of default after the restructuring of that particular loan,
yes,
with the probability of default that was there on initial recognition of that loan.
Yes.
So the comparison still is there, and you have to look at whether the borrower would be able to repay the restructured amount of the loans or not.
Yeah.
And I have a question here. You talked about historical data and the fixed data. How do you make the distinction?
Well, so what I mean is that basically, if you find some errors or something in the data, it's important that you still say, what historically did you have, because otherwise, you're not going to have the sort of audit trail on what ECL you came up with. But you also have to have a database with, here's the up-to-date data that will be used for our training models and so on. Because it's common in some companies that, you as an employee, you find that some default was set wrong or something like that, and the company will say, no, we can't fix it because we need to keep the sort of audit trail. So, it's going to stay the way they are. But then you train all the models with the wrong data. This is what I mean by this separation. Make sure that there is a sort of, here is what I use to build my models. Here is what we have to sort of show what we historically had. So sorry if that wasn't clear, but that's the distinction I really want to emphasize there. I think we have one slide. No, then that was a sorry for it being a little bit rushed here, but feel free if anyone also have some questions that wasn't answered here and so on. Then feel very much free to reach out. I mean, I love talking anything IFRS 9. Just really quickly, there was one really interesting question in chat. There was someone who said, if it's default, can we set ECL equal to 100%? Strictly speaking, you would only set it to 100% if you say there's no ability to recover whatsoever. IFRS 9 typically says you should always have one scenario with loss and one scenario without loss. So even if you have a loan that is in default, there is a chance for the customer to recover. There is a chance that you will be able to get some cash flow out of them. I mean, ECL 100, that's just at ECL 0. That should be very, very rare. And you should really ask yourself, if you can be in that position, why have you no ability at all to get back some money from a defaulted customer? So again, it goes back to your fundamental credit management.
Okay, thank you very much, Jacob. I think we are running short of time, and I would like to appreciate all the efforts that you and Imad has put to bring up this presentation. And definitely, the session was very insightful. I hope most of the questions of our audience has answered. Of course, it's a very detailed topic. We cannot cover everything, and apologies if we have missed out any question. But again, I appreciate your efforts to conduct the session, and everyone, all the audience, thank you so much for joining on this weekend. It's a weekday, it's very difficult, I understand. But I hope it's a very beneficial session for you. And let's stay connected. We'll bring more sessions for you, inshallah, in the future with great panelists and experienced people. One more thing that I would like to add, that the presentation will be uploaded on our YouTube page, and all the participants who have registered with us will get a copy of the presentation as well. So not a problem. Thank you very much. Appreciate your presence, and thank you, Jacob and Imad. It was very nice to meet with you all again. Take care. Have a
Thank
nice
you.
weekend.
Really lovely.
Bye-bye.
Thank you, all you guys, for the great questions. Keep talking.
Thank you.
Thank you.